our time is so fast. So 10 minutes from now, our Zoom will already end. So will you go to the multiple choice theory? I'll just give you the letter answers. Please review them.
Excuse.
Yes. Ano?
Magalyon, ma'am, present. Sorry, nadula ko,
Oo.
Abi.
Sige.
Magalyon. Thank you,
Magayon.
ma'am.
Si Lusada, wala pa. O, karon lang. Sige. Now, letter answers for... Why pa ito na record? We will begin recording when we have the chapter 3. We have multiple choice theory. Record ka na. Subong ko lang. So good. Oh. Okay. Theory number 1, C. Number 2, 3, 4, 5, dog. 2, 3, 4, 5, dog. 6, boy. 7, C. 8, 9, dog. 10, A. 11, C. 12, boy. 13, dog. 14, 15, 16, 17, C. Okay? Then 18 dog, 19 dog, 20 boy, 21 dog, 22 A, 23 boy, 24, 25, 26 C, 27 dog, 28, 29 C, 30 boy, 31 C, 32 boy, 33, 34 C, 35 dog, 36 dog, 37, 38 boy, 39 C, 40 dog, 41 A, 42 C, 43 A. Okay? Now, as a footnote
Yes,
to
ma'am.
explanation of number 4
Ma'am.
is dog. Any question?
Ma'am, sa book bala ma'am, pagkatapos ma'am, sa 33 ma'am, 35 na siya ma'am, dayon
O,
36, bali
may
wala, 34 ma'am.
may number na da ang na-miss, number 34. 34
Yes,
lang
ma'am.
ang na-miss. So anyway, disregard it, no?
Okay,
I'm not
ma'am.
giving the question anymore. That's quite long. So anyway, it's only one. Now you skip number 34 and delete the answer. Okay?
Okay, thank you, ma'am.
So for an explanation to number 4, why the answer is dog, cost model recognizes any dividend declared or paid by the subsidiary and is classified as income. So in other words, under the cost model, if the parent will receive any dividend declared or paid by the subsidiary, that dividend is classified as income regardless of the retained earnings balance, which means that there is no such thing as uh, liquidating dividend under the cost model. In other words, the fact that under the cost model, you cannot adjust the investment account unlike under the equity model. So in other words, you cannot credit back the fact that under the cost model, the investment account should still be carried at cost. But that is under PAS number 27. Under FASB ruling, a liquidating dividend still exists even if you are using the cost method. So there's a conflict between the two models. We are now following PAS 27. In the case of number 11, C, a partial equity is the same as with equity method, except that the amortization of the allocated excess is not recognized in the investment and income account. So to explain number 11, letter C, partial equity is the same as with equity method, except that amortization of allocated excess is not recognized in the investment and income account. Now, anyway, you try to answer the theory, multiple choice theory for any time. I will just give questions out of those theories that we have. Now, our main concern this time is to answer the assignment. That's problem number 1. It's quite long. Problem number 1 is with 6 requirements but with different cases. So we were not even finished up to number 2 in our 9 to 11 class. So I hope we will be able to finish what they have finished. So anytime we will have the lectures on the same level. Now, in problem number 1, the ownership of the parent is only 80%. And we will be preparing consolidated financial statements. And goodwill that will be considered may be partial or proportionate approach, and it may be full or fair value basis. Now, let me read the important part of the problem before we go to the requirements. On January 1, 20x4, Pascal, which we now will call P only, P company acquires 80% of the common stock of Saks. Now we call this XS company for 372,000. So that is the consideration paid by the parent. At that time, the fair value of the 20% non-controlling interest is estimated to be 93,000. On that date, the following assets and liabilities of Saks company had book values that were different from their respective market values. So we now have the first column, book value, and second column, fair value of the assets, some assets, and liabilities of S. So we have now the inventory, had an undervaluation, land also, then the equipment. The book value is the difference between 180 and 96. So the book value is 84, but the fair value is 180. By the way, I'm just eliminating zeros. Just try to consider that I am dealing with thousands. All right, so the book value in the books of S of the equipment is the difference between its cost and the accumulated depreciation. So the book value is 84,000, whereas the fair value on January 1 is 180,000. So really, there was an undervaluation. Then, for buildings, building, now the cost is 360,000. The accumulated depreciation is 192,000, meaning the book value or the carrying value of the building is 168,000, while the fair value as of date is only 144,000. There was an overvaluation. Then we have the bonds payable, book value of 120,000, but the fair value is 115,200, which we are going to account separately afterwards. Okay? So if we try to determine the book value of these assets with adjustments and the fair values, the total of the net assets at their book values, 204,000, while the fair values, net fair values, the total is 294,000. So 204,000 book values, net and fair values is 294,000. The difference, which represents undervaluation, is 90,000. January 1, 20x4, the equipment and buildings had remaining lives of 8 and 4 years, respectively. Inventory sold in 20x4, 5 for inventory costing is used. So the cost of this inventory will already go to cost of sales, though there is an undervaluation of 6,000 that we have to consider. Goodwill, if any, is reduced by 3,750 pesos impairment loss during 20x4 based on the fair value or full goodwill basis, meaning the management has determined that the goodwill arising in the acquisition of S company relates proportionately to the controlling and non-controlling interest, as does the impairment. Now we have the trial balances of the two companies by December 31, 20x5 and 20x4. Now, given are the balances in the trial, in the individual trial balance 20x4 and 20x5, we have the individual trial balances, and finally, we are going to prepare combined balances. So we have now cash, accounts receivable, inventory, land, equipment, buildings, investment in S company with the amount